Hi, hello, welcome to my channel. Today we are going to see short terms and keywords in trading. So, which normally used in a regular basis during the trading. So, which will be helpful when you are seeing the next video or relevant videos. Tax. First, let's see short terms relevant to buying and selling. So, first term is long. Long means it is another word of buying. So, if you somebody is staying and go for a long, then it is called buying. So, the market is in uptrend. So, if somebody is staying short, then it is a selling. So long is like nothing but buying, short is nothing but. So next one is C and P. So C is nothing but call option. So that is actually if market is in uptrend, then you have to go for a C, which means buy the C, and put option means if the market is going down, it is going to be a downtrend, then you have to buy a P option. That is put option. So next one is bullish and bearish. This is normally we used in the market. So bullish means nothing but market is in uptrend, and bearish means market is in reverse trend. That is in. So next short terms relevant to price action. So here we are having important two words. One is supply zone and demand zone. So this is very important. So market is going up and down like this. So you can see the one point here. This is the highest point. So if the market comes again at this point, so if it is reverse from here, then this is called supply zone. So which means more sellers are available at this point, which means PE. Okay. So the same way the demand zone is like that. So if the market is in downtrend, so afterwards in 1 or 2 days it is in sideways, and then immediately it is coming down and meeting this point. So this point is called demand zone. So from here this may reverse, which means so here responsive buyers are more. So that is we have to go for a call option. So next one is candlestick. So in trading actually we are having a plenty of candlestick, but here I have taken only few. So that is most important in the trading. So first one is VIX. Actually VIX is nothing but, so you will have a general schematic of candle is. So this is the general schematic of candle. So this is called body. So this is called VIX, which means top, and this is bottom VIX. Okay. So second one is body. So as I said, this is the body of the candle. So third one is doji candle. Doji candle is actually a very important thing. So basically it will be like this. So it is the signal of there is a equal seller and buyer at this point. So the body will be very small, thickness will be very small, and wicks will be more. So it says that here buyers and sellers are equal. So from here maybe the market may go reverse, which means if a market is on upper trend, so like wicks is happening somewhere here at the upper point, there is a chance of getting down from here. Okay. And this thing hammer is nothing but it's an important point indication in the trading. So hammer, the same thing like a doji, but upper candle will have a body, and lower part there will be a long wicks. Maybe upper side there will be a small wicks, but lower part will have a long wicks. So this actually denotes that the market is going to be a uptrend. The same way a reverse hammer will be like this. So body will be small, and then wicks will be more up, and bottom wicks will be maybe little bit, or without that also it may appear. So in this case there is a denote that the market is going down, which means The responsive buyers, responsive sellers actually come into the market. They're trying to push the so next one is day wise. We are having 3 days. So one is trending day. Trending day is nothing but, so once the point is start, maybe the day will be bullish like this, not a straight, maybe there will be up and down, but this is called trending day. Maybe upward, uptrend, or this is called downtrend. So this is downtrend, this is uptrend. Okay. And if market is said to be sideways, then it will be like this. So there will be a equal buyer and seller. So third one is like volatile day. Volatile day is nothing but any festival days or any parliament news coming, any big companies getting down or getting up. So those days are called volatile days. So those days normally we have to avoid the trading. Normally in that day actually the chart will be like this. So there will not be any control. So there will be a maximum of next one is support and resistance. If you see my previous video, I have given a brief of CPR. So in that actually CPR is nothing but 3 line. So upper you can have a upper, you will have a resistance, and bottom to the CPR you will have a support. So this one is called S1, this one is S2, this one is S3. So resistance is nothing but R1, R2, R3. So this is the point, may it may reverse. So this is the point, it may go up. So this will act as a support and this point will act as a resistance. So next one is indicators. So normally I during my trading I used this pivot points and EA. So pivot point is nothing but like as I said in previous slide. So S1, S2, R1, R2. So this is R1, R2. So this is S1, S2, S3. So these are all pivot points. So coming to the exponential, EA means exponential average. Actually we are having a different exponential average. Maybe in upcoming videos we can see detailing. So which will be the average of the trading. So this will be act like this. If it is trend is up, then this will be average line will be like this. So if the trend is downward, then the average line will be denote like. Okay, that's all from today video. So I hope you enjoy this video and it is something relatable to you. So please share and subscribe and share to your friends. We will see in the next video. Thank you.